Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscription page on our site. We intentionally keep the technical analysis charts to the subscriber's report so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term about confidence and sentiment. This month I'd like to update you on developments within some of our MATA SIIs, the Strategic Investment Initiatives. Last quarter, I focused on the tectonic forces at play and how important the Trump initiatives would be in maintaining market momentum and resolving how the forces might play out. As such, I would therefore like to cover the following subjects shown here, with more emphasis this month on some of our specific SIIs. In my 2017 thesis paper entitled The Illusion of Growth, which can be found on the MATA SII subscriber site under Annual Thesis, I argued in 110 pages that U.S. economic growth is not as reported because the GDP formula is both archaic and misleading. I recently posted at metasii.com on September the 29th an article entitled An Archaic GDP Formula Hides the Fact the U.S. is already in a depression. That gave additional perspectives on some of my views. The central issue is, do you consider debt as income? I don't. As a consequence, if you acknowledge for the sake of argument that government debt is not actual national income, the following graph is how the U.S. economy looks like excluding stimulus. This is actual GDP excluding artificial stimulus. The U.S. is in actual fact in an economic depression. Only a flawed perspective shields us from the startling reality of this. In addition, we are facing historic pressures which are changing the underlying fabric of our economic and financial system, how we do business, how we live, how we communicate. As great as technology and internet technology is, it has become an employment income destructive force. Someday everybody will realize this. We argued in previous SII updates that we had two tectonic forces in play, the end of the debt supercycle versus the government and central bankers' policy initiatives to keep the game alive. So far, the latter are winning as the Minsky melt-up continues higher. For how much longer may not be as important as understanding what will occur when the central bankers lose control. That will happen. There's no question about this. The capitalist system isn't built around this kind of command and control system. I am watching closely to see whether Japan's targeting of real per capita growth will become the dominant strategy that will unfold. As I pointed out in the latest Under the Lens and Macro Analytics videos, we may soon see new forms of nationalization, if I can use that terminology, using facility guarantees and conservatorships or other means to begin to emerge to keep financial markets from imploding from their own weight of massive over-leverage within the system. Based on this, let's first talk about our U.S. retail SIIs. Currently, the U.S. economy is nearly a 70% consumption economy. That level of consumption is dependent on debt continuing to grow parabolic as shown here in red. The question is that possible? Few appreciate that 44% of that economic consumption, 70% of our economy, is now totally fueled by new credit creation, as shown here. This is not a new problem. What is new is the magnitude of the new credit now required to be created and the methods being used to create it. The black line in this graphic shows how disposable income, less the cost of living, has been squeezing Americans' ability to consume. What has offset that is more personal debt and credit growth, shown here in red, as well as, and this is important, government transfer payments like food stamps to 52 million Americans, disability payments, etc. Money that's given out to the public by whatever policy to Americans, which is spent on consumption. How long this can go on is not today's subject, but rather the pressures it is putting on the U.S. retail sector and other sectors. Squeezed by weak income gains, higher health care and educational costs, and the burdensome load of debt from years past, consumers simply have less money to spend and appear less inclined to spend what they do not have on apparel and other department store goods. Further, they have little propensity to borrow to consume more, which is slowly shifting. I think a lot of this has to do with the shifts in demographics as the baby boomers are now moving into their non-consumption years and pension years. Since January 2016, department store sales year over year declined in every month except 2. A continuation of these trends has major implications for retail stalwarts like Macy's and Nordstrom's, as well as commercial and retail real estate. More shopping is now done online, as we're all well aware, recently crossing 10% mark, and how department stores have consequently suffered a particularly steep decline in the share of overall U.S. commerce. As a result, many big retailers are shuttering stores across the U.S. Sears, a venerable retailing chain that dates back to 1886, has announced plans to shutter more than 300 locations just this year, and that will leave it with 1,150 stores, just over half the number 5 years ago. And as we go to press on this, I just read this morning that Sears Canada, the original Simpson Sears Canada, is now being shuttered, closing all stores and going to lay off 12,000 employees in Canada. So the numbers are actually bigger than I just previously stated. North America could well have too many shopping malls. On a per capita basis, the U.S. has twice the space of Australia and 5 times that in the U.K. Report estimates are for 25%, minimally, maybe higher, of all shopping malls in the United States could be shut down by 2022 due to the current woes of the retail industry. That is profound. Credit Suisse recently estimated that as many as 8,640 stores, some have it as high as 10,000 store locations, with 147 million square feet of retailing space, could close down in 2017 alone, which would surpass the level of closures after the financial crisis and dot-com bust. The retail sales associate is one of the most popular jobs in the country, with roughly 4.5 million Americans filling the occupation. In May, the U.S. Bureau of Labor Statistics released data that found that 7.5 million retail jobs might be replaced by technology. The World Economic Forum predicts 30 to 50% of retail jobs will be gone once struggling companies like Jim Boree fully hop on the digital train. Market Watch found that over the last year, the department store space bled 29,900 jobs alone, while general merchandising stores cut 15,700 positions. At this rate, one Florida columnist put it soberingly, half of all U.S. retail jobs could vanish. Just as ATMs replace many of the bank tellers, automated checkout stations are supplanting retail clerks. And I think for anybody that's been shopping lately, you're seeing more and more of that as you queue up to get near a kiosk. Surviving retailers will do it the same way the savviest brick tenants are already doing and thriving today. 1, by selling at the same price one can get anywhere on the net, never being undersold, by having great customer service, and 2, by absorbing online ordering as an in-store service. You try on one shirt in the store, buy it, and then order 5 more on the spot, right there from the retailer's website. This is the shift that's occurring. What this means is continuous pricing pressure, which is bringing down top-line growth and squeezing margins profoundly. And those companies and retailers with heavy debt, which is the most of them, can no longer or will no longer be able to support its debt. Never mind interest rates possibly going up, or their bond interest payments going up as their credit ratings are reduced. Bespoke Investment Group has constructed a Death by Amazon index made up of companies most at risk from competition from Jeff Bezos' online retailing juggernaut, and there has been a sharp divergence from the broader U.S. stock market since 2015. Let's recap our investment thesis for this one SII. We have a secular trend going on in retail. We're overstored by a factor of 6 times. We have a 70% consumption economy. The closest to us is in the 50s. We have a tapped out middle class, and for years we always felt that we couldn't believe, or you could never count out the U.S. middle class to consume. That day finally arrived. And for those that do recall, in the 80s and 90s, this was always the big question. Well, it was 20 to 30 years later, but it finally is beginning to arrive. Online pricing pressures that we just talked about and everybody's aware. And maybe what most people aren't aware is the amount of balance sheet debt levels that are within the retail chains and the retail stores. Distribution models have failed, that is, the failed department store model and the mall dependencies that people have built up. These are major changes as I've just spelled out above. So what are we seeing so far in Q3? Well, what I'm seeing is it's accelerating, and I think that 2017 is going to be the tipping point year in retail. It's the worst year in U.S. retail histories. We have, as I said, 9,000 to 10,000 store location closings, and likely will accelerate again in 2018. We have already 300 bankruptcies by mid-year of this year having filed and more coming. We're seeing the terminology Amazon starting to become broad-based, and everybody's reacting, worrying about, and anticipating getting killed by the Amazon effect. Amazon has critical mass, invests everything it makes back in for growth, quality, and service. It's not chasing profits like all other companies who seem to be forced to do, and rightly so, but Amazon has got around that. It has not had to argue that, and it actually has the lowest cost of money of any other corporation, and matter of fact, its cost of money is less than that for China. So what I think is happening is that Amazon really is becoming the new department store. And by that I mean you can go to Amazon and buy anything like you could in a department store, except here you get it at the cheapest price with the best service and immediately deliverable. We're also seeing the tremendous movement of retail robotics accelerate. That is becoming noticeable in all forms, and I've made a couple videos on that. What we're also seeing is as it's sweeping across various industries, restaurants are now starting to see, I believe, the impacts. It could be the next wave. I believe we're going to see it in family restaurant chains as a segment which is above the fast food section and below the higher quality tablecloth group. This is where the chains reside. We refer you to the subscribers section for our targeted watch list of retailers by various categories we feel are most exposed. We have just added another section there for retail focused on restaurants specifically. Restaurants face similar issues as retailers with problems extending across all categories of the food sector except the high-end segment. Restaurants' same-store sales have experienced 17 consecutive months of year-over-year declines, according to the July 2017 Restaurant Industry Snapshot Black Box Intelligence Report, and I quote them. These are the weakest 2-year growth rates in over 3 years, additional evidence that the industry has not reversed the downward trend that began in early 2015, end of quote. Adjusting for inflation further clarifies the difficulties the sector faces. Wilf Richter at Wolf Street shows adjusted sales at fast service and drinking places for inflation are shown here, and he found that sales as reported in 2017 are up only 22% from the post-recession lows and have been stagnant since December 2015. Our focus on the SII is on, as I mentioned, on casual dining segment with specific heavy dependency on mall locations. Shown here is an example of what we are considering as examples, where we've segmented it both for larger chains and the smaller chains, who are still got very high stock prices. And we've screened this as examples of the kinds of screening we're looking at. Though this chart is nearly impossible to read, it is, however, available at our subscriber site. The takeaway of this chart is which chains are most exposed and where. How many stores are in hurricane-hit areas like Florida, Texas, Louisiana, or in areas such as a $15 minimum wage pressure experiencing in California? And some of these with dominant mall positions in their chains are highly exposed to near-term losses on bottom line growth. These and other factors are influencing our watch list selections for your consideration within your portfolio strategies for those meeting the qualifications for shorting and being supported by your financial advisor. Let's shift to another SII, another one in retail, but auto. Auto sales appear to have peaked in late 2016, and used car prices have been in decline since 2014. Car and truck sales have helped lead the economy out of the recession over the past 8 years. The surge in sales to new record levels was not solely due to outright sales, but was heavily nourished by extensive use of lease financing. Because of the reliance on leasing, cars rolling off leases topped 4 million units last year and are expected to rise by 11% in 2017 and 2018 and top 5 million units by 2019. This will produce and is producing a glut of used cars on dealer lots and fueling the decline in used car prices. That's the residual values that they use on lease rates. Projected used car prices, also known as residual value calculations, are a major component of the lease finance equation. As 11 to 12 million used vehicles hit the market over the next 2.5 years, the stage is set for problems in the lease vehicle market and total car sales. At their peak in February 2016, auto leases accounted for 1/3 of new car sales, and the 6-month moving average remains above 30%. As the leasing option becomes more expensive and used car supplies continue to grow, new auto sales are likely to suffer. The impact of the used car market on leasing can be seen through the purchase versus lease analysis shown here on this table. A decline in used car prices, that is the residual values, as is currently forecast, dramatically alters lease payments, eliminating leasing as a lower cost alternative. This is a massive problem. The bull, base, and bear case for used car prices is based on forecasts from Manheim Morgan Stanley, who are the professionals in this area, Manheim specifically. So to recap, the investment thesis for retail auto is it's in a cyclical trend, not secular. We had peak sales at 18 million thereabouts. We expect 15.5 million, and a lot are forecasting it going down to as low as 13.5 million on an annualized basis on this particular cyclical trend. We have a finance trap that we've never seen before, and it's hard to imagine that the automotive companies fell into this trap without a strategy. 1/3 of sales are now leased, with the numbers being 3, 4, 4, and 4 minimum million cars returning in the next 4 years. The developments that I'm seeing, though, in Q3 are in some ways the auto industry starting to figure out how to get around this massive problem. And I believe they're moving, and this is my opinion, they're going to move to more of regulatory arbitrage. And I mean by that using regulations from government and tax incentives to stimulate car sales. We saw that with the Cash for Clunker program during the 2008, after the 2008 financial crisis. This one will be different. Nobody seems to be interested in electric cars, but I read just recently that they're going to announce 50 new models over the next 12 to 18 months from all car manufacturers. General Motors is going to come out with 20 alone. All of these have been, up until now, major losing propositions financially for the OEMs, and additionally, products that the consumer has not wanted. If they can force, through regulations, tax incentives, and other means, they'll be able to keep the prices up. New cars will be moving to EV, to electric volt, and therefore they won't have this massive residual or people moving and buying the used cars, force prices down on new cars. It's almost the only way out. And the government, with the automotive industry, such a dominant part of the U.S. economy, and the U.S. facing a possible recession, I think they frankly have the government over the barrel, and they know it. Also, we need to be aware there'll be a short-term hurricane boost panacea as cars have to be replaced, but that's all it is as it pushes up. So watch very closely as you start to hear more and more about electric cars, because if we don't, or they have another strategy, the bottom is will continue to fall out. And we have various categories, as you are aware, within this sector, from parts dealers to OEM to suppliers to leasing, etc., to even the car leasing companies as categories in various instruments for you to look at. Shifting to defense, another one of our investment SIIs this year. The investment thesis here originally was geopolitical tensions that we were anticipating, and that they would be the highest and most global since the Cold War. ISIS, North Korea, Iran are on the books today in the newspapers. We anticipated this. We anticipated before the elections that this would be a major area, and the charts have shown bared it out quite well. We also believe there would be a tremendous amount of social unrest from populism, changing of guard, which would create uncertainty. All of this leads to typically various forms of defense spending. Defense doesn't necessarily just mean guns and munition. It can mean a lot of communications and security systems used within the war effort, whether domestic under a civil war or against a traditional enemy. What it does is it drives up defense expenditures around the world, and the biggest defense contractor or supplier is the American economy. So what we're seeing now is, and it's a heads up here, if you look at the chart for Northrop Grumman and Lockheed, they're straight up without any kind of correction. And it's been going on for some time now. And so various companies have different charts. And it's sending a signal of much more than the defense spending, because the defense spending increase in budget is only about $60 billion. There's something else much bigger going on here. And we saw smart bombs showcased during the Iraq War in 1990-91. Then we saw later on in the decade stealth bombers, stealth fighters start to arrive. Now and most recently, we've been seeing drones. These are all major shifts in technologies that have been made available to the public. But I think something dramatic is coming that integrates a lot of that. And I think it will be below water versus above water. And I'll be writing more on that as we go forward, because it reduces dramatically the cost of military reactions around the world more effectively. Also, things such as in cyber war, such as electromagnetic pulse technologies and new disruptive technologies. These are the things that a lot of these companies in our defense contractor watch list are working on, are part of, and it shows up in the chart, even though nothing has been announced or has necessarily even yet been shipped to the military. The other part of defense that, and we pointed this out before, is the dividend yield. They're incredibly high dividends relative to any other industry, and the world is chasing dividends. And with buybacks, issuing bonds at cheap, and being able to improve the dividend yield, these companies continue to increase quite dramatically and are definitely holding up their stock price. So these are not short candidates, these are long candidates, and again, we refer you to the technical analysis in the subscriber section. Another one of our original SIIs was infrastructure, and our investment thesis that on it was we felt that it had bipartisan support. Both parties needed it. We have a crumbling infrastructure in the United States. 50 years of useful life is long past. The maintenance cost is now becoming prohibitive in our total infrastructure, from dams and bridges to aqueducts to roads. It's just broad. It's a completely and totally broad base, and the maintenance costs, as I said, are prohibitive, and it's actually putting the United States in a competitive disadvantage. So both parties campaigned on this. What we're seeing now is the budget, and Trump was looking for in the area of $60 billion, which is pretty small in actual fact, but the hurricane damage in Texas, Florida, Puerto Rico alone is going to consume a big chunk of that. So I don't think the budgets are going to allow for the infrastructure short term. Also, though both parties support it, there's a massive difference in how it's going to be funded. The Republicans wanted public-private partnerships versus the Democrats wanting government ownership. The difference being one is fees-based, as the user has to pay a user fee, versus another, it's taken out of your taxes. I don't think this will end well, especially when I look at the success it's having had on Obamacare, replace and repeal, and even the budget tax reform discussions to date. I don't think it's going to unfold near term. Though we have some in the portfolio, if you look at them on the watch list centered around the building of the wall and who will win in terms of aggregate and gravel suppliers. The FANG and NOSH would be the last one I want to talk about. The investment thesis there originally was that quantitative easing and ZIRP would drive it, and that has been the case. And with $8.3 trillion of G3 balance sheet expansion in 8 years, and now printing 275 to 300 billion a month, that is not the United States, but basically Japan and the ECB, the charts of the G3 and the FANG and NOSH stocks have tracked dramatically. Also, we felt that the explosion of ETF would lead to a significant movement in these stocks, which has in fact happened because of liquidity. What we're seeing now in Q3 is the announcement of quantitative tightening. And whether we see that and whether it actually unfolds, this is going to pull the rug out from the liquidity that has been pumped in. I don't think that will actually unfold. We will get some scares, and then as talked about in a number of videos, I see other ways of new forms of nationalization coming in to support this. So the FANG and NOSH still have more to run, though they're not going to be quite as easy to get as they have been before. The bond market is betting against, in actual fact, the implementation, or whether we see real GDP per capita, as Japan appears to have a different strategy being adopted by other players. One of the points I would make is that right now we're already starting to see the G3 balance sheets come off, and we're seeing a divergence as shown here, which is a significant technical warning. So I think this is showing we may see some sort of near-term 2.5%, maybe a little higher, scare within the market. But having said all of that, as I often do, I need to remind you that no matter what, they will print the money to solve any and all problems until such time as no one will take the money or it has no value. That's what you must continue to remind yourself of. As problematic as the market looks, as scary as things may be, as overvalued and overstretched as things are going to be, and there will be major scares, they will react by simply printing more money until nobody will take it. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2017 turn out to be an outstanding investment for you and your family. Thank you for listening.